Insight into auditing.
Financial statements. Ever wonder how a business knows if it's building a skyscraper of success or a shaky foundation? The answer lies in its financial statements. Think of them as the blueprint for a business's health. They tell you exactly what's happening inside. These are the powerful documents that tell a company's story in numbers. There are three core statements you need to know: the statement of financial position, also known as balance sheet, the statement of profit or loss, also known as income statement, and the statement of cash flows. Together, they paint a complete picture, and each one gives us a unique perspective on the business. Along with these three main statements, the statement of changes in equity, together with the notes to the accounts, are considered integral components of the financial statements. First, the statement of financial position, also known as balance sheet. This is a snapshot of a company's financial position at a single moment. It answers the question, what does the company own and what does it owe? The fundamental equation is assets equals liabilities plus equity. Assets are what the company owns, like cash and buildings. Liabilities are what it owes to others, like loans. And equity is what the owners have invested. Next, the statement of profit or loss, also known as income statement. This tells the story of a company's performance over a period of time, like a quarter or a year. It answers, did the company make a profit or suffer a loss? The key formula is simple: revenue minus expenses equals profit or loss. It shows how much money came in from sales and how much went out for things like salaries and rent. Finally, the statement of cash flows. This tracks the actual cash coming in and going out of a business. A company can be profitable on its income statement, but still run out of cash. This statement is divided into three activities. Operating activities track cash transactions from day-to-day business operations. Investing activities track cash transactions from buying or selling assets. And financing activities track cash transactions from obtaining or repaying loans or equity. This statement tells the real story of a company's cash flow. The statement of changes in equity is the bridge between a company's income statement and its balance sheet. It tells a powerful story, explaining why the company's net worth went up or down. It shows how profits, dividends, and other transactions impacted the owner's stake. In contrast, the notes to accounts are the story behind the numbers. While the main statements provide a summary, the notes give you the essential details and context needed to make informed decisions. They explain the accounting policies a company uses, break down complex line items, and reveal crucial information about things not on the main statements, like potential lawsuits, pending guarantees, or transactions with key executives. What's really powerful is how these statements connect. The profit or loss from the income statement flows into the equity section of the balance sheet via statement of changes in equity. And the ending cash from the statement of cash flows is the same cash balance you'll see on the balance sheet. They are all interconnected, providing a complete, consistent view of a company's financial health. In a nutshell, we can say that it provides a structured summary of a company's financial position, performance, and cash flows. It is used by stakeholders like investors, creditors, management, regulators, etc. for decision-making. It includes 5 components: the statement of financial position, the statement of profit or loss, the statement of cash flows, the statement of changes in equity, and the notes to the accounts.
Thank you for watching.
For more videos, hit subscribe button below.